G'day, welcome back to all our viewers to another exciting episode of our podcast series. And today with my co-host Sihle Tuta, we're going to be talking about misconceptions around trading. Within the trading industry, there's a lot of misconceptions. So tune into the different points and topics that we're going to be covering in today's episode. And remember to follow us on all our social media pages and of course, Instagram, Facebook, Twitter. We're all there, including Telegram as well. So follow us to keep up to date with what's happening at Exness. Sihle, how are you, mate?
Good on you, Terence.
Very well, thanks. And I think today's topic is quite an exciting one. We're talking about misconceptions around the trading business, the trading industry as a whole as well. And you've been in it for many years now. I mean, you've seen stars come and go, so to speak. And those that are genuinely successful are still there.
Yeah.
And is it a scam? I think that's where we'll start off. Is FX trading a scam? Is it? I think that is always the question around trading and FX trading in particular.
So thank you for the question, Terence. So there's a lot of myths and misconceptions around trading as a business.
Right.
Now, I never really understand why people always single out Forex, apart from all the other tradable instruments, and question why it's a scam.
Yeah.
When there are so many tradable instruments that traders choose to trade, I suppose it's because of the popularity of Forex as an instrument. A lot of promoters have went out of their way to promote Forex particularly. Trading is a serious business. I mean, if we look at all the parties who participate in Forex trading, we're talking governments, we're talking central banks, retail banks, hedge funds, retail traders. So there's no way that an asset class that commands such huge trading volumes with all these big institutional companies participating is a scam. But obviously, because of the promoters and the affiliates who use unattractive methods to attract their clients, that is what makes it look like a scam.
Right.
And to come to the topic of the myths and misconceptions of trading, I think one that comes to mind is that it's a get-rich-quick scheme.
Yes.
Now, we know, if you open your social media right now, if you open your Instagram, you will see all these guys who use flashy things and shiny things, their cars, whether they own them or not.
But what's the catch there? I mean, what's the catch of using the Ferrari? I mean, like apparently California is being
I suppose it's because they're trying to convince the masses that this works.
Yeah.
Because if I can afford a car like this, then so can you.
Okay.
Just buy whatever I'm selling, whether it's signals, whether it's a course, or whatever it is. Because obviously a lot of people would take a lot of convincing to part ways with their money if they don't see the success you are selling in you. Right? If I say to you, Terence, as an example, my signals have 80% accuracy, so pay for them. So if my signals are so good, then obviously logic would suggest that they should work for me. So the only way you, as an unsuspecting client, that these signals work for me is to see, I suppose, the material things which define success in the world we live in.
The environment.
So the car, the cash, the jewelry in some cases are the easiest things that these people use to convince unsuspecting clients that, okay, I'm doing well. But I think the first one that comes to mind for me, the first myth or misconception, is that trading is a get-rich-quick scheme.
Yeah, very, very quick.
Yeah. I mean, we've seen ridiculous claims, people saying that they can double their money every month.
Yeah.
They can make 80% every month, which is ridiculous.
Yeah.
And I think the question is here, can you make a lot of money too quickly? And I think the answer to that really requires some thought, because we know trading is a double-edged sword, right? It cuts from both sides. You can make a lot of money too quickly, but you can also lose it just as quick. You know what I mean?
Yeah.
So you can make a lot today and lose it all tomorrow, right? So if you think about this long term, and if you look at it as a business, you don't want to adopt that method of trading where you're making a lot today and losing it all tomorrow. You want to try and focus on small, consistent gains over time and see how your money has grown over 12 months.
Right.
Of course, we're not here to give out financial advice. We just talk about trading ideas. Trading is risky. You can lose some or even all of your money if you don't stick to risk management principles.
Right.
So point number one for me is that the myth is trading is a get-rich-quick scheme, and it's not. It's not at all.
It's not. Wow. So you mentioned promoters, right? And the lifestyle they sell. I mean, the Ferrari California has been one that has been very popular around these social media, promotions, so to speak. Of the vehicles. You've got gold BMWs, silver Mercedes, and so forth.
Yeah.
And then we have the other types of promoters who seem to have been in the game for a while without naming anyone in particular. They'll offer you training courses, they'll offer boot camps in very, exotic resorts, or at exotic resorts in Scotland, somewhere in the mountains, and, come here and we'll train, we'll do this. During the days, we'll be exercising, doing all of that kind of stuff. So even them, would you say there's legitimacy around that, what they're offering?
So remember that most people who are involved in the business side of trading, whom we call partners or affiliates or introducing brokers, if you like, many of them attach a lifestyle, a certain lifestyle to trading. And it's usually a lifestyle that most beginner traders aspire to.
Yeah.
Right? So they have to project a specific image, right, for you to take an interest into whatever they're selling. Because the end result of somebody who takes on a course is that, or it should be, that they acquire a skill that is going to enable them to be able to make money consistently. Right? So there has to be a lifestyle that's attached to that. Yes, to answer your question, yes, there is a legitimacy attached to that, but I think there's also a danger to it because it can create unrealistic expectations,
right?
Especially to beginner traders, guys who are new in this industry. Them thinking that, okay, this is going to be easy. I'm going to start making money overnight. I'm going to start making money after attending the course, which is not, reality. Trading can be challenging. It is a business.
Right.
Sometimes you're up, sometimes you're down. Like in any business. I mean, 1 month you'll be profitable and the 1 month you're not. But you've got to be able to be in a position to manage your success over long term.
Right.
Because you're not trying to get rich quick, as we said in our first point. You're trying to make small, consistent gains where you can look at your performance in 12 months and realize that you're better off now than you were then. You know what I mean? Yeah.
Wow, that's very remarkable, Sidley. And I remember looking at a report in 2023, and it was talking about the top 10 hedge funds and their performance, in particular in the US. And I think the gentleman's name is Ken Griffin. His hedge fund was top of that list, and they'd made something like 16 billion, in over a year, trading. I'm taking it from 2022 to 2023. And they were trading geopolitical risks and all of these kind of events that were happening around the financial markets, interest rates, and so forth. So I'm taking that to speak to what you are saying, that, this is real business, that even, the professionals are getting involved in the same asset class, taking a position, whether it's to buy or to sell. But it's not a one-day shoot kind of...
It's definitely not, Terence. I mean, this is a long-term business which involves a lot of parties in the ecosystem. Central banks, like I said earlier, retail banks, retail brokers, promoters, retail traders. So there's a lot of people who are involved in the whole ecosystem. So it's definitely not, the business of trading is not a scam.
It's not a scam.
Definitely not. But I mean, we are obviously parties in this industry. So getting rich quick is one. I mean, in your space, with all the people that you interact with, the traders that you interact with in your travels, what have you picked up to be, a myth or a misconception when it comes to trading?
Yeah, this is using your phrase, a double-edged sword, where a number of them feel that brokers are out to get them.
Yeah.
And in my conversations with them, I've also said to them, look, there are brokers that are genuinely out to get you.
Yeah.
And I think this is the world of trading in general. It does not make it right, but hence regulation then needs to come into place where there are certain practices as a regulated broker you cannot partake in. It's similarly as banks or as hedge funds.
Yeah.
But even when you trade the financial markets, normally when you sit at a bank or a particular stockbroker or anything, market manipulation happens with regards to, traders favoring a particular direction. Like if you recall, there was that situation with GameStop, where that was being the stock was being short by traders and then institutional traders, and then retail traders came in with a lot more flow to overcome that side of the trade. So, those are the views that are traded in the market, and people then say it's manipulation.
So it's not necessarily that the market is being rigged.
No, it's not the market. The market isn't. You can't rig the market.
Yeah.
And that showed that. To say if the market feels that the trade or the view you are trying to trade is wrong, they can turn against you, and no one can really win against the market.
On the back of that statement that the market is impossible to rig, what is it then, in your opinion, that creates massive, sudden moves in the markets?
Yeah. So, again, we've got, large institutional traders, and I mean, this speaks to the myth of trading, if it's a scam or whatnot. And these are part of the points. And these massive moves, I mean, like the hedge fund that I mentioned earlier, they made profit of above $15 billion US dollars.
Yeah.
So to make that kind of profit means that you've got a very significant position
in the market.
And when you begin to unwind that position, it's going to affect the market, So it's the supply and demand that is coming from a particular position. The market has been long US dollars for many years now. And one of the popular trades has been the carry trade between the US dollar and the Japanese yen.
Yeah.
And now that the Bank of Japan has increased interest rates, that trade is now being, unwound. Traders are starting to get out of that trade because it's no longer as profitable as it was. Borrow for free, trade, invest, and then, pay back nothing, essentially.
So pretty much the big players, which is the hedge funds, the banks, the guys who have access to big capital, are basically the ones who move the markets, because if they take a specific position, it's obviously going to create movements in the markets.
Yes. So it is in terms of the institution. So typically the institution can be one way, in terms of their long-term trade. So maybe they've got a desk of 15, 20 traders, and there's a house. They are favoring long gold, for example. And in that long gold position that they are favoring, the entire desk is maybe that way in terms of their long position. Day to day, they could be, intraday trading, but they've got a larger long-term position that is sitting one way. And when that trade hits the profit level or the loss level that they can no longer handle, they decide to get out of that trade. And that will shake the market. That will move the needle for sure. It's different from Terrence sitting $100,000, buy. I mean, it's not going to move the needle.
So we've spoken about get rich quick, and then the market is rigged.
Yeah.
I think another one that comes to mind while we're having this chat is that especially from a retail trading point of view,
Yeah.
is that you can be right all the time.
Yes.
And we know this is far from the truth.
Yeah.
I think this is simply because of all these lagging indicators that new traders come across, and they sort of believe in them. There's moving averages and the stochastics and all these things, which can lead you to think that, okay, if I have this moving average crossing this one at this level, then the price is going up, and it can end up you thinking that you're going to be right all the time.
Yeah.
And especially the more experience and the more knowledge you acquire, I think there's a certain level of arrogance that you create, especially after you've experienced a certain level of success, right? Maybe you can call it beginner's luck or whatever you call it, right? And then you think, okay, I've won the last 5-6 trades, which means then I've got this, right? Then you end up thinking you're going to be right every single time.
Yes.
And then what happens there, then you start to double up. You start to increase your risk and you increase your lot size. In many cases, unjustifiably so, comparing to the size of your trading account, because you don't know when a losing trade is going to come, right? And it usually comes when you start getting cocky, right? So the point is, you will not be right every single time.
No, you can't.
There's no way.
Yeah.
Even some of the most educated finance people from these fancy universities who trade for the fancy, hedge funds and at the banks, with all the resources they have at their disposal, even they are not right every single time.
No.
You know what I mean? So which means you have to play the risk game accordingly if you want to be in this business for the long haul. I know personally traders who are right 4 or 5 times out of 10, but they're still on the upside. Obviously, now that comes with the risk-to-reward ratio, how you're managing your risk, how much you're risking and how much you're taking, all that. But you don't have to be right every single time
No, you don't
to be profitable.
Yeah. No, you're right, Sihle. And I think even in my conversations with the traders, that's where the psychology of it comes in, for them to understand what it is they're doing. In a very important part that you mentioned is risk management. And understanding what risk you are managing. Because the moment you double up, you are increasing your risk.
The risk, yeah.
And the myth then becomes, the broker saw that I was increasing my risk. That's why they waited for me. They gave me these wins. They gave me these wins so that I can increase my risk and they can wipe me out quickly. No. The moment you increase your risk, it's a different management of the situation altogether. Right? That's number one. And number two, there are certain tools that people often don't use the right way. For example, a stop loss. Like you said, your friend who's a trader, he gets it right 4 out of the 10 times. And that's a very good return. But the difference is how the stop loss works. It's not necessarily to say, you've lost, this is it. You go to bed crying and you wake up to live another day tomorrow. A stop loss psychologically is to indicate to you that there's something you got wrong.
Yeah.
You might have gotten it right, but maybe you didn't execute it right. Some information came into the market. You didn't watch out for that. So that indicates to you that the risk parameters have changed that you need to manage. That's number one in terms of psychology. Number two is your friend who gets it right 4 of the 10 times. How you get it right is also important. Because he can get it right 4 times and make 100. That's 400,000 of the 4 times. And of the 6 times, he can get it absolutely wrong. But when he gets it wrong, it's 2,000. So which is 2,000 times 6, which is 12. 12 minus 400, we do the math. The difference is very much a large 300,000 up.
So the point is, when you lose, you must lose small.
Yes.
When you win, you must win big.
Exactly.
Because losses are part of...
They're part of the game. And that's where you find the myth around an obsession around technical analysis. To the point where a lot of traders feel that successful strategists or analysts are people who can speak to technical analysis. And often that shows me the level of depth that you have in terms of understanding the financial markets.
I think that is where it actually comes from.
Yeah.
This thing of thinking that you can always be right.
Yes.
Because there is a teaching that says that patterns in the market are predictable.
Yes.
Yes, they are to a certain degree, but it's not absolute.
Yes.
Right? A pattern can go against what you're used to. So
Definitely.
because you're used to a certain pattern forming a specific way, and then you put all of your money in what you expect to happen next, and then it doesn't happen, it can invite a certain level of frustration to the trade, because you know that, for instance, a head and shoulders, it forms the shoulder, the head, then the next shoulder, then that's what's going to happen next, and then it doesn't, which can be frustrating.
Exactly.
I think for me, another one that comes to mind is that, I see some traders and I see their charts, right? And you see indicator upon indicator, and it's just a messy chart.
Yeah.
Because they believe the more complicated and the more sophisticated a trading strategy looks,
exactly,
the more likely it's going to succeed.
Yes.
And two, the more trades I take, the greater my chances of success.
Yeah.
Which, in my opinion, is further from the truth.
Very far.
I know traders who are doing very well, who trade on clean charts.
Yeah.
Maybe one or two indicators at most.
At most.
But they just look at price. But it baffles me how you can see anything on a chart that has 8, 10 indicators.
And you're trying to make sense of everything.
You're trying to make sense of everything.
Yeah.
I suppose it gives one a sense of importance to say, look at me.
That's it.
I'm academic. And it's not the case.
It's not. You're so right, Sitle. And where it also gets very interesting with that is the head mentality. Where the entire industry is then built on this technical analysis. For example, Bitcoin, for example. Very few people can explain Bitcoin and its moves up or down without referring to chart or some form of technical analysis.
Why is that, before you carry on with the main point you are making? Why is that?
Because Bitcoin is a very difficult thing to explain why it's going up or going down. So they turn to technicals to explain that, to find the reason. There's different applications that are out there that will show you some kind of depth of book with regards to where a lot of buy orders are, where a lot of transactions are happening and so forth. That's the flow of cash. And they try to explain why Bitcoin is going to hit 80,000 to preempt the next move. But I think, at least from my seat, I've seen that Bitcoin is very much a supply and demand, and it's moved by fundamentals that affect that supply and demand, interest rates, the availability of cash. One of the biggest times that Bitcoin has done very well was during the COVID pandemic. And the reason why people were not going to work, people were looking for an income, they had a lot of cash on them, interest rates were at historic lows, so there was a lot of cash. And people played around with that cash, and that's as simple as that. But it can't be that simple. It needs to be something else, the halving event, the this, the that, and all of those play a factor like anything.
There's a lot of moving parts.
They are part of the moving parts. But it can't be as simple as you said. That guy, and often the successful traders just understand it as simply as that, including successful investors. They see the simplicity of where things are, where they're going, why they're going there, and they trade that view. That's all it is, trading a view of where it's going, and people miss that. That it's like me and you right now, Sitle, having a cup of coffee, and we have a view of where we think the rand is going to go given everything that's happening. And we put money on it. That's as simple as trading. Outside of the charts, and we can be massively right. If we had traded the GNU, for example, would have been sitting extremely pretty on that without having to look at the chart. Just on what we feel around the sentiment around it. So yeah, that's part of the myths, but again, technical analysis is an easier resource to get hold of.
Yeah.
You can read. There's a lot of material on the internet that you can read on why the indicator should do this and that and what it means. Whereas it's difficult to understand why inflation does what it does and where it's going to go. I mean, the central banks have been struggling with it themselves, and they are the top fundis of the world. So that's why people then tend to gravitate towards that. But it's a wrong misconception to think that someone who comes and throws a lot of technical jargon to you and explains all of this, that is the superior analyst.
Yeah.
And they know what they're talking about. And this guy will come and tell you, look, the GNU is good for South Africa. Buy the rand, sell the dollar. He doesn't know what he's talking about because it's too simple.
Yeah. Look, I think this is obviously a fascinating topic. And we can talk about this for hours on end.
Yeah.
But I think the 4 points that we've discussed, for me, quite stand out, which is like, trading is not a get-rich-quick scheme.
No, it's not,
Secondly, that the markets are not rigged.
Yeah.
And 3, you can't be right every single time.
No,
you definitely can't. And obviously, the final one, that the more complicated the trading strategy or the more indicators you have on your chart, the better your chances of success. And that obviously the more trades you take, the more you're likely to succeed, which is obviously further from the truth. Your parting shot?
Live to fight another day when you're trading. Remember there's always another day. Don't over leverage, don't over trade, which speaks to those 4 points that you've made, and at times it's as simple as that. It doesn't need to be complicated. And often it's not as complicated as it's made to seem. I think, trading is like golf. You trade on your own, you make a decision on your own, you play the game on your own, good or bad shot. You can't really blame the course, can you? Maybe. But it's your game to play. It's your trade to make. That will be the parting point from my side for sure, Sihle.
I think for me, trading is a business and it needs to be approached accordingly. It's not going to happen overnight. You need to have all the right tools, the education, the right broker, and obviously the trading capital, because we all know that you need the trading capital.
You need the capital,
And just take it a day at a time, man.
No, thank you. Well, to our viewers, we hope you found this intriguing topic, very informative and useful for your business and your trading experience. And most importantly, we hope it has demystified a lot of the myths that are out there for you to be able to make wiser decisions in your trading journey and business. And join us for more exciting episodes that will be released later as we go. And follow our podcast series as well. This will be beneficial for your business as we include other guests as we go on with the series. And remember to follow us on all the social medias on YouTube, Facebook, Instagram, Twitter, Telegram as well. And remember to like and subscribe. So from Sihle and myself, it's bye for now.
Cheers.